Imagine standing in front of a giant vault filled with stocks, thousands of them, all shining, all promising, all whispering, "Pick me, I'll make you wealthy." But how do you choose? How do you know which one is worth your hard-earned money and which one is a beautifully wrapped financial trap? That's where one little number can change everything. Today, we dive into the world of the P/E ratio, a simple but powerful tool that has helped beginner investors become confident, helped seasoned investors avoid disasters, and helped value investors uncover hidden gems that many others overlook. And by the time you reach the end, you'll understand this tool so clearly that you'll be able to analyze a stock like someone who has been investing for years. So stay with me, because once you truly grasp the P/E ratio, the stock market stops feeling like a gamble and starts feeling like an opportunity. Before we go deeper, let's start with the simplest question. What exactly is the P/E ratio? The letters stand for price-to-earnings ratio. That's it. Simple. The P is the price of one share of the stock. The E is how much profit, how much earnings, one share makes. The P/E ratio tells you one powerful thing: how much investors are willing to pay for $1 of a company's earnings. Let's imagine two companies. Company A earns $1 per share, and its stock price is $10. Company B also earns $1 per share, but its stock price is $30. Which one is cheaper from a value investing point of view? Company A has a P/E of 10. Company B has a P/E of 30. That means people are paying $10 for every $1 of earnings in Company A, but $30 for every $1 of earnings in Company B. This raises a natural question. Why would anyone pay 30 times earnings when they could pay 10 times for the same thing? And that's where the story gets interesting. The P/E ratio doesn't just show value, it shows expectations. Company B might have a higher P/E because people believe it will grow faster in the future. Maybe it's launching a new product, or it's in a booming industry, or investors simply believe it has huge potential. Company A, with the lower P/E, might be stable and reliable but not exciting. Or maybe investors are worried about it. Maybe its industry is slowing down. And here comes the heart of value investing. Just because a stock has a high P/E doesn't mean it's good, and just because a stock has a low P/E doesn't mean it's bad. The real question is the price justified by the company's future? A lot of new investors make the same mistake. They buy stocks simply because they are cheap or avoid them because they are expensive. But price alone means nothing. The P/E helps you compare price to what truly matters: earnings. Let's pause for a quick thought-provoking question you can answer in the comments section. Do you think most investors pay more attention to price or to value? And which one do you pay more attention to when you look at a stock? Drop your thoughts below. I'd love to hear your angle. Now, back to the journey. There are different kinds of P/E ratios, but for beginners, two are the most important. Trailing P/E, based on past earnings. Forward P/E, based on expected future earnings. Trailing P/E is like looking at a company's history. Forward P/E is like looking at its potential. Both can be useful, but both can also mislead you. If earnings are declining, the trailing P/E might look cheap until the future reveals the truth. If analysts overestimate future earnings, the forward P/E might look too optimistic. So how should beginners approach this? By remembering one thing: the P/E ratio is a tool, not a decision. It helps you ask deeper questions, not jump to conclusions. Let's explore an example in a simple, everyday way. Imagine buying a small shop. Two shops are for sale. Shop 1 earns $1,000 per month and costs $10,000. Shop 2 earns $1,000 per month and costs $30,000. You'd naturally ask, why is Shop 2 3 times more expensive for the same earnings? Maybe Shop 2 is in a high traffic location and is expected to grow quickly. Maybe shop 1 is in a quiet neighborhood and its earnings might decline. That's the PE ratio in real life. Value investors, like Warren Buffett, love using the PE ratio because it helps them avoid overpaying. Buffett's famous rule is simple: never pay more for a business than it's worth. But how do you know what a business is worth? That's where analyzing earnings through the PE ratio becomes extremely useful. Here's something most beginners don't realize. A company with a very high PE ratio might be priced perfectly, if its future is bright. A company with a very low PE might be a bargain, or a warning sign. This brings us to an important question for you. Would you rather invest in a stable company with a low PE, or a fast-growing company with a high PE? Tell me in the comments. I'm genuinely curious which type of investor you are. Now let's talk about how value investors use the PE ratio in the real world. They don't just look at the PE in isolation. They compare it to 3 things: the company's own past PE, the average PE of its industry, the overall market's PE. Why? Because a company can look expensive on its own, but cheap compared to its competitors. Or it can look cheap, but only because the entire industry is struggling. Here's an example. Tech companies usually have higher PE ratios because they grow fast. Utility companies usually have lower PEs because they grow slowly. Comparing a tech company's PE to a utility company's PE makes no sense. It's like comparing a sports car to a bicycle. They serve different purposes. So the next time you look at a PE ratio, ask yourself, compared to what? Let's make this more fun with a relatable scenario. Imagine going to a grocery store. You see 2 apples that look almost identical. One costs $1 and the other costs $3. Before choosing, you ask, is the $3 apple bigger, sweeter, organic, from a premium farm? If the answers are yes, maybe the higher price makes sense. If not, you'd think, this $3 apple doesn't seem worth it. That's the PE ratio. It helps you understand whether the price matches the quality. Now I want to ask you something truly important. Have you ever bought a stock just because it was cheap? Or avoided one because it looked expensive? Be honest, and tell me your story in the comments. You never know who might learn from your experience. Now let's uncover one of the most misunderstood parts of investing. A stock with a low PE can be a trap. Yes, you heard that right. A low PE might mean the company is in trouble, earnings are falling, the industry is shrinking. Investors expect bad news. This is known as a value trap. It looks cheap, but it keeps sinking. On the other hand, a high PE stock might be a rising star, but only if the company actually grows into that high expectation. The key is balance. Value investors don't chase low PE or high PE. They chase truth, the reality behind the numbers. So the real purpose of the PE ratio is not to tell you what to buy. It's to tell you what questions to ask before you buy. Speaking of questions, here's one for you. If you could only use one metric to evaluate a stock for the rest of your life, would you choose the PE ratio or something else? Let me know in the comments. I'm curious what you value most. Before we go deeper, if you're enjoying this video so far and learning something new, do me a favor. Like this video, subscribe to the channel, and share it with someone who wants to start investing wisely. It really helps us bring more powerful content like this to you. Now let's continue. Understanding the PE ratio is like learning to read the label on food. Once you know it, you'll never shop the same way again. Imagine opening your stock app in the future and immediately noticing, this stock has a PE of 50. That's high. Why? Or, this stock has a PE of 7. Is it undervalued or just struggling? Congratulations! You'd be thinking like a value investor. One thing most people miss is that different types of companies naturally have different PEs. Fast-growing companies usually have high PEs. Stable, slow companies usually have low PEs. Cyclical companies, like car manufacturers, might have misleading PEs depending on the cycle. So never judge a P/E ratio without context. Now let's think deeper. Why does the market reward some companies with high P/Es? Because investors are paying for the future. And why does it punish others with low P/Es? Because investors fear the future. Which raises another question for you. Do you think the market is more often overly optimistic or overly fearful? Share your take in the comments. Let's wrap up with something powerful. The P/E ratio is a map. It won't walk the journey for you, but it will guide you away from danger and toward opportunity. It helps you slow down, think clearly, and invest with purpose instead of emotion. You don't need to be a financial expert to use it. You don't need complex formulas or insider knowledge. All you need is curiosity, patience, and the discipline to look at facts instead of hype. And now that you understand it, you have one of the most valuable tools in the world of investing. Before you go, I want to leave you with one last question, one that could change how you invest forever. If you had to choose between buying a great company at a fair price or a fair company at a great price, which one would you choose? And why? Tell me in the comments. I can't wait to read your thoughts. If you enjoyed this video, don't forget to like, subscribe, and share it. Your support helps us bring more powerful, beginner-friendly investing content just like this. And remember, investing isn't about being perfect. It's about learning, thinking, and making decisions with clarity.